Welcome to the Deep Dive. Today, well, we're plunging into a really fascinating showdown, one that investors talk about all the time.
That's right. We're talking Amazon versus Apple.
Exactly. Two absolute titans. I mean, they delivered these incredible, almost hard-to-believe returns over the years.
Oh, completely. Think about Amazon, right? Since its IPO back in '97, the stock's up over 220,000%.
220,000%. It's just staggering. And Apple, since its 1980 IPO, over 59,000%. Imagine getting in early on those.
It's amazing history, no doubt. But, and this is the key thing, right? We always say it. Past performance, those huge historical gains, they absolutely don't guarantee future success.
Yeah, that's such an important point. History's got plenty of examples, doesn't it? Companies like Blockbuster Video, maybe even BlackBerry.
Exactly, cautionary tales. They were dominant, but things change. Past glories didn't save them.
So that really brings us to our mission for you today. We're not just looking back, we're asking the big question for right now.
Which one? Amazon or Apple? Which is a better stock to buy today?
That's it. And we're going to stack them up, look at recent performance, their financial muscle, growth prospects, valuation, even dividends.
The goal is to give you a clear, really informed perspective on this, well, ultimate stock showdown.
Okay, let's dive in. Where do we start? Maybe recent performance. Momentum.
Yeah, good place to start. And if you're watching momentum, well, Amazon has definitely been grabbing the headlines lately.
It has, hasn't it?
Uh-huh. Remember, earlier in the year, there were those tariff concerns. Both stocks took a hit.
Right.
But since late April, Amazon's been on a really strong run, jumped nearly 30%.
Wow, 30%. That's a significant bounce back. Shows some real confidence returning, doesn't it?
It really does. So right now, Amazon's trading, what, around $212, $231?
Yeah, $212.81 as we're looking. Market cap is huge, $2.3 trillion.
And it's interesting, that price is much closer to its 52-week high than its low, shows that upward push.
And the gross margin looks pretty healthy, too, almost 50%. 49.16% to be exact.
Which is strong.
Yeah.
But one key thing for some investors, no dividend from Amazon.
Right. No dividend. Now, what about Apple on the performance front? The different story recently, isn't it?
It is, yeah. Less positive, you could say. Apple also fell sharply with those tariff worries.
Mm-hmm.
And while it's recovered some ground, it's actually still down quite a bit for the year, around 20% year to date.
Okay, so a 20% drop year to date for Apple versus that near 30% gain for Amazon recently. Quite the contrast.
Definitely signals maybe a more challenging patch for Apple in the short term.
Looking at Apple's numbers now, it's around 196 porns. Still a massive market cap, though, even bigger than Amazon's at $2.9 trillion.
Right. But notice its current price is, well, quite a bit further off. Its 52-week high compared to Amazon still has more ground to make up.
Its gross margin is also solid, 46.63%. Bit lower than Amazon's, but still strong.
And it does pay a dividend. Small, but it's there.
Yeah, a yield of about 0.5% at 0.51%. So, okay, picture painted. Amazon showing strong recent momentum. Apple navigating a bit more of a struggle lately.
Precisely. Now, let's pivot to financial strength. This is where it gets really interesting.
Because they're both financial powerhouses, obviously.
Yeah.
But stronger. How do we measure that?
Exactly. It really depends on what metric you focus on, like raw cash on hand.
Okay.
Amazon actually has more, over $94.5 billion in cash, equivalents, and marketable securities as of the last quarter.
$94.5 billion. Wow. And Apple?
Apple had $48.5 billion, so significantly less on that specific measure.
Okay, so point to Amazon for cash pile. But wait, what about debt? Doesn't Amazon carry more debt, too?
Ah, good point. Yes, it does. Amazon's debt load is about $157.9 billion.
Compared to Apple's.
Apple's is lower, around $98.2 billion.
So Amazon has more cash, but also significantly more debt. How does that shake out?
Well, if you look at net cash, so cash adjusted for debt, Apple actually comes out ahead.
Okay, net cash favors Apple. What other measures are key for financial strength?
For me, one of the absolute best measures is free cash flow. It really shows a company's underlying financial health, its ability to generate cash after all expenses and investment.
Right, the cash left over to do things like pay down debt or buy back stock or reinvest.
Exactly. And here, Apple is just a monster. Over the last 12 months, $98.5 billion in free cash flow.
$98.5 billion, wow.
Okay.
And Amazon?
Amazon's was $25.9 billion, are still a very healthy number, don't get me wrong.
Sure, but nowhere near Apple's level.
Not even close. Apple's free cash flow generation is just phenomenal, really highlights that cash machine.
That is a striking difference. So Apple generates way more free cash. Does that give it a fundamental edge, maybe for future investments or returns, even if Amazon's overall size is similar?
It's a great question, and it leads perfectly into growth, because it's a bit of a paradox.
How so?
Well, while Apple kills it on free cash flow, Amazon has recently been the clear winner on actual growth rates.
Okay, tell me about that. Recent growth.
So in its last quarter, Amazon's revenue, up 9% year over year. Solid.
Pretty good.
But here's the kicker. Earnings. They soared, up 64% year over year.
64% jump in earnings. Whoa. That's not just growth. That's like hyperdrive. What's behind that?
It really signals a potential shift. Maybe years of heavy reinvestment are now really paying off on the bottom line. It points towards operational leverage.
Operational leverage. Making more profit from each dollar of sales, basically.
Exactly. It suggests Amazon might be moving into a phase where it's not just about top-line growth, but serious profitability improvement, a more mature, earnings-driven story, perhaps?
That's a huge insight. Okay, so Amazon showing that powerful earnings leverage. How does Apple compare on recent growth?
Well, Apple's recent growth, frankly, pales in comparison. Revenue and earnings both up around 5% year over year last quarter.
Okay, 5%, still growing, still solid, but yeah, not that explosive 64% earnings jump Amazon posted.
Right. But looking forward, both companies still have strong potential growth drivers.
What are they?
For Amazon. Well, AWS, the cloud unit, is still expected to be huge, right? Especially with everyone building and deploying AI models. That needs cloud power.
Makes sense. AI is everywhere.
Plus, they're pushing into new areas. Healthcare, satellite internet with Project Kuiper, lots of potential new frontiers.
And Apple. What are their big future growth hopes, besides just selling more iPhones?
Well, there's always that potential for a brand new product category to ignite things. You know, the rumors about smart glasses persist.
Ah, yes, the Apple glasses. If they ever launch that and it takes off.
It could be a massive new revenue stream, a huge catalyst. So potential on both sides, just maybe different types of potential.
Okay, growth picture is clearer. Now, valuation. How does the market price these two giants? Is one cheaper than the other?
Generally speaking, based on some common metrics, Apple looks a bit more attractively valued right now.
Like what metrics?
Let's take the forward price-to-earnings ratio, the PE ratio. Basically, what you pay for expected future earnings.
Lower is generally better, right?
Yeah.
Cheaper relative to earnings?
Usually, yes. And Apple's forward PE is around 24.75. Amazon's is higher at 33.4.
Okay, so Apple looks cheaper based on forward earnings. What else?
Then there's the PEG ratio, price to earnings to growth. This tries to account for growth expectations. Again, lower is often seen as better. Apple's PEG is about 1.8. Amazon's is quite a bit higher at 2.39.
So on PEG 2, Apple seems to offer more growth for your buck at its current price.
Based on those metrics, yes. It suggests Apple's valuation might already factor in its slower recent growth, making it look more appealing relative to its future growth prospects.
But are those the only ways to look at valuation, especially for a company like Amazon that, reinvests so much and have that big cloud business?
Excellent point. No, they aren't. And Amazon actually looks better using a different, also very important metric, enterprise value to EBITDA.
Okay, EV to EBITDA. Break that down quickly.
Sure. EV, enterprise value, includes debt and cash, giving a fuller picture of the company's total value. EBITDA is earnings before interest, taxes, depreciation, and amortization, sort of a proxy for operational cash flow.
Right. And how do they compare here?
Amazon's ratio is 17.3. Apple's is higher at 21.7.
So on this metric, Amazon looks more attractive.
Correct. This ratio can be more insightful for companies with significant debt or big capital investments like Amazon. It suggests that when you consider the whole capital structure and operational profitability, Amazon might actually be valued more reasonably.
Fascinating. So it really depends which lens you use to view valuation. PE and PEG favor Apple. EV to EBITDA favors Amazon.
Pretty much. It underscores why you can't just look at one number. You need the whole picture.
Absolutely. Okay, one last category, dividends. This one should be quick.
Very quick. We mentioned it earlier. Amazon
Doesn't pay one.
Correct. Apple
Does pay one. So Apple wins this category by default.
It does. But as we also noted, the yield is, well,
Tiny. Puny. 0.51% forward yield. It's not exactly lighting the world on fire for income investors.
not at all. It's more symbolic than anything else, really.
Okay, so let's wrap this all up. We've looked at performance, financials, growth, valuation, dividends. What's the final verdict?
Well, putting it all together, you see just how close this contest really is. They both have clear strengths, but in different areas.
Right. Recap the highlights. Amazon leads on.
Recent stock momentum, definitely. And that really impressive recent earnings growth, showing that operational leverage kicking in,
And Apple's advantages.
appears to have the edge in overall financial strength, especially that massive free cash flow generation.
Right.
And its valuation looks arguably more attractive based on traditional earnings metrics like PE and PEG.
Plus, it has a dividend, even if it's small.
Plus, with the dividend, yes, for what it's worth.
So it really does sound neck and neck. If you personally were forced to choose one right now, based on everything we've discussed.
It's tough because, honestly, they represent slightly different investment cases right now. If you're really betting on that growth story re-accelerating, fueled by things like AI in the cloud, and you believe that incredible bottom-line improvement at Amazon will continue and start making its earnings-based valuations look better over time,
Then Amazon's the pick.
then Amazon looks very compelling, yes. That shift towards profitability is a powerful narrative.
But on the flip side,
On the flip side, if you prioritize that rock-solid financial base, incredible free cash flow, a maybe more conservative or traditional valuation,
then Apple looks good.
then Apple looks incredibly attractive. It feels perhaps a bit safer on those metrics, for me personally, given Amazon's demonstrated pivot to profits and its diverse growth paths.
Yeah.
I see maybe slightly more explosive upside potential there in the next few years. I actually own both stocks, full disclosure. But if I had to pick the best one to buy right now, I'd probably lean towards Amazon, believing in that growth and profitability story unfolding.
Very interesting take. So we've covered a lot of ground. Historical wins, current financials, growth paths, valuation nuances. It really brings it back to the listener, doesn't it?
Absolutely. For you listening, what factors do you weigh most heavily? Is it that potential for explosive growth and improving margins like Amazon offers?
Or is it more about that steady financial stability, the immense cash generation, and maybe the more conventional valuation profile you see with Apple?
There's no single right answer. It really depends on your own investment philosophy, your goals, your risk tolerance.
So we encourage you to think about how the strengths and weaknesses we've talked about align with what you look for in an investment. How do you navigate these choices between market leaders?
It's an ongoing process in this ever-evolving market.
Indeed it is. Well, that's all the time we have for this deep dive. We hope this comparison has given you some valuable food for thought for your own investing journey.